So this segment's going to be Opportunity Zone Investing Trends. Paul St. Pierre is a wealth advisor with PSP Advisors, has a lot of Opportunity Zone expertise, has been on panels all over the country, and has written for Opportunity Zone magazine in the past as well, I believe. And John Chiaretti is with Novogradac, which is the professional services firm that I don't think there's a professional services firm out there that has more Opportunity Zone experience and expertise than Novogradac does. And Novogradac has a qualified opportunity fund survey that they do to try to corral all of the data around opportunity zones and just exactly how much equity has been raised by all of the different hundreds, if not thousands, of opportunity zone funds all around the country. So I wanted to start there with you, John. Could you share with us how much equity has been raised so far to date by opportunity zone funds all around the country? And maybe you can drill into some specifics on what type of equity raised in what types of properties.
Yep, sure. So we've been tracking fundraising since early 19. We don't obviously track all of the funds. We think we're probably capturing 30% or more, a little more of the marketplace. And right now we're tracking 1,613 funds, and of which 1,231 of those funds have reported fundraising to us. So we think the real total is 3 to 4 times what we have in our fundraising report. The funds that we track are going to be your public funds and funds that we sort of direct survey, but they're all multi-investor funds that we're tracking. Through the third quarter of this year, Jimmy, our total is $32.6 billion. So we think, we're probably upwards of around 100 billion on the total marketplace.
Good. Well, that's what I've been telling people. That's been over 100 billion for a little while now. So it sounds like I'm in the ballpark there.
I think you are. It's interesting. This year, we've reported that 8 billion has been raised through 3 quarters. So we're on sort of a $10 billion year, which would be the biggest year. So, we're seeing some downward trends in the last 2 quarters. So what I mean by that is the last 2 quarters, that'd be the third quarter of this year and the second quarter of this year, there was $2 billion raised out of that $8 billion. And so, the first quarter of 2022 and the fourth quarter of 21 were $4 billion quarters. So you're seeing a little downward trend. And when you look at timing in this investment, obviously there's a lot of things that trigger investment. The third quarter tends to be a trigger point because partnerships and the like, that's sort of their deadline, because the pass-through deadline is through the due date of the partnership tax return. So when you look at this year's third quarter, it was about 20% less than last year's third quarter. So it does anecdotally kind of represent a little bit of a slowdown in fundraising. As far as what assets are being invested in, primarily real estate, at least of what we're capturing. 75% of the money's actually targeted to multifamily. I think we're up to like 125,000 units in our survey. And so, but the lion's share of the money is multifamily. Only 8% of investments in our survey are targeted to operating businesses. So, and I think it tends to be the big funds that we're surveying. I think a lot of operating business investment in this space gets done privately, and a lot of it's smaller chunks over longer periods of time, not these big chunks, for real estate. So that's kind of where we are on the fundraising and the types of assets that are being invested in.
Great. Well, thanks for laying the groundwork there, setting the stage for us, John. I love that survey data. I wrote an article about your survey that came out. I'll link to that, and I'll link to the survey itself in a minute here in the chat. Paul, I want to turn to you now. We've got some mixed signals, I feel like, from the OZ marketplace. On the one hand, Opportunity Zone equity raising keeps treading along pretty nicely. We're on track for $10 billion of equity raised this year, according to the Novogradac survey, which would indicate probably really, 30 to 40 billion, considering how much of the marketplace they're able to capture. But at the same time, it's someday we may see a slowdown here. There's a little bit of a lag with Opportunity Zone funding in that, it usually takes place within 180 days of a capital gain event. And with the markets turning down the way they are, and a lot more investor uncertainty and interest rates going up and inflation rearing its ugly head, and maybe we're in a recession or heading toward a recession, there's a lot of macroeconomic uncertainty. How do you put all that into context, Paul, with respect to Opportunity Zone investments, and how do you consider OZ investments for you and your clients?
Yeah, let me tie into John's comments. I mean, I'm one of the oldest veterans on the table here, on the panel here, but the OZ program was created in the Tax Act, in the tax code. So I consider the QF as just as another tax creature. It wasn't created in the securities laws. It wasn't created in state laws. It's really a creature of the tax laws, as John's firm well knows. There's only a couple other tax creatures that preceded it. It's the Investment Companies of 1940 was the first tax creature in the tax code. The REITs were created in 1960. The business development companies were tacked on in 1980 under the 40 Act. And then along comes the QOF bolt-on in 2018. The results are exceptional. I was in the REIT market in 1986, 87, before all the real estate developers got out of debt trouble and converted into REITs. But before the growth in the REIT market, it was a backwater business. The market cap of REITs was only about $8 or $9 billion when I was involved in it. And so these results of capital that's being swept in to the Opportunity Zone market, you get inflation adjusted or whatever, go back and look at the growth of the 40 Act companies. Hockey stick, very slow traction and adoption for both the REIT market and the mutual fund market. The results here for the qualified opportunity funds is exceptional when you consider the headwinds. 2 years without regulations. Regulations finalized the day of the emergency declaration for COVID. So big backwater there. Then we have the COVID years where investment capital, sort of that freeze of we don't know what we want to do, but we certainly know we got to deal with COVID. And now we're facing a recession, but the numbers are exceptional. I was really impressed by the first IRS, by the Treasury report, reporting, I guess John knows, $20 billion into qualified funds from tax data. This data is exceptional. So the problem is, or the challenge really is, first, let's talk about wealth advisors. Wealth advisors manage trillions of dollars of managed wealth. It's the registered investment advisor market. I've carried those credentials for the better part of 40 years of being on the advisor side. So that is the area where we need to do a lot more penetration to educate wealth advisors about how this fits in to investor portfolios. And there's more that comes to the table than just the client and the wealth advisor. This is a sophisticated product. It's not complex. I hear people don't want to do it because it's complex. No, it's a sophisticated product, and it should appeal to the intellectual curiosity of the wealth advisors. But I always say, the estate planner needs to come to the table during those discussions. The tax planning professionals all need to come to the table. It takes a village to quickly grasp the understanding of how this product works for the clients. I think the wealth advisors are behind the 8 ball on this. If you look at many of the established wealth advisor channels, the big brands, they don't touch anything until the product goes through central due diligence for these wealth management firms. So it's got to go through centralized due diligence. Then it's pushed down to a product on the shelf that the wealth advisors can show. So keep in mind, we're going against long-term history of this is the way we do it for 20 years, and this is the way we're going to do it for 20 years. So when it comes to alternative investments and things that don't normally sit the box, it takes time to go through the top of the funnel, the wealth advisor companies, due diligence of the product, educate everybody how it works, how it fits in the client portfolio. Unfortunately, it takes time. And whenever anybody asks me, we don't have time to waste. And the wealth managers to get on board, waste no more time. This program is only open to the end of 2026. So get on board and make the program work. I have more to say about it, but I'll certainly lace some more comments in the rest of the panel time here, Jim.
Yeah, well, let's get John to give a response to that. John, what do you agree with Paul? There's been a kind of a slow uptick from the RIA and wealth advisory community. Do you agree with that? And why is that? And what's the solution?
A slow uptick.
It's a slow uptake. It's been slow. I think I misspoke, but the wealth advisory community has been kind of slow to pour energy into the OZ program.
Yeah, I mean, I think high net worth family office is the lion's share of investment. Although we do have some clients that have made their way into the wealth advisory community. And yeah, I think it takes time. Problem is we don't have a lot of time on the back end. So and then sort of being once removed from this sophisticated investment, it's probably a more difficult sale, I would think, because now you have sort of the tax benefits you're explaining on top of your normal economic benefits of an investment. So there's a learning curve in how to sell it.
Is there a headline risk there too, given the response that this program received from the media when it was first brought out in 2019? Do you think that's still a fear for the wealth advisory community and also some of these larger institutional players that haven't really come to play yet?
Yeah, I mean, potentially there could be. I mean, I don't know for sure, but I know there are some, wealth advisors that large wealth advisors that are participating, so that you would think would be just as concerned about headline risk as some of the others. So it's, maybe not.
Yeah, fair point there. What about other trends that both of you kind of have your eye on as we wind down 22 and head into 2023, particularly given the current macroeconomic climate with respect to opportunity zone equity raising and capital deployment? Any trends that you're anticipating so far to date? Multifamily has been by far and away the most popular asset class. Do you expect that to continue or change, or any other thoughts that you may have? Paul, I'll open it up to you first.
I think there's a lot of upside here. One of the comments I really want to make, if you take the last presentation, for example, well done. I tremble when I have to follow Jill Holman. I mean, she's got way more medals in terms of contribution to this industry. But when I look at the last presentation, these programs, all these funds, all these investment initiatives, they work for taxable investors as well. This is not just for the QOZ investor, for that club. We always say it's the deal, and the tax benefits are purely upside optionality. And I think the industry, to the extent that it can keep attracting even non-OZ capital, because there's a fundamental economic premise here. These are great deals. That's the upside to keep attracting capital to these deals. I think one of the panelists just talked about distressed QOZB deals. I've certainly been thinking about it. I'm not afraid of it. It's probably a great opportunity to buy into partly completed projects in OZs without having to take the 3 years of zero return on a pre-development, pre-shovel ready project. The wild card is going to be federal tax legislation. We don't know what it is. We don't know when it is. I tell everybody in OZ works, don't pray for it. We have a program that works here in the OZ program. There is no time to waste. Get on with it. Make this program work. If there is federal tax legislation, I hope it's all positive benefits and not further takeaways. finally, with regards to reinvestment and all the other things, these OZ census tracts expire on December 31st, 2028. It's a hole in the program. There is no identification of what all the census tracts are going to be after 2028. For those who are thinking of reinvestment, the reinvestment will stop in 2028 unless there's some identification of version 2 of census tracts. Basically, very, very positive about this market. It's really dollars and deals. How do you raise enough dollars to get the money invested fast enough into shovel-ready projects, dollars and deals? Anybody in this business is trying to balance that really difficult challenge is dollars and deals.
Absolutely, Paul. Yeah, the 28 thing is kind of interesting. You're right that the zones technically are only in existence through 28. I spoke. I have hope that they're going to get that sorted out. By the way, I spoke on a panel last month at the OZ Expo with a member of Secretary Mnuchin's team at the Treasury Department that wrote the regulations, and I won't mention him by name, but you can probably guess who he is. He mentioned he didn't think that was an issue at all. I think either it's not really going to be an issue for whatever reason, or it's going to be resolved.
It'll be resolved.
John Paul brought up tax legislation possibly pending here. Maybe with our final few minutes here before we get to a couple of questions. We just had an election yesterday. We don't know the outcome for certain in all the races. It looks like the Senate may very well be determined yet again by a runoff election in Georgia. Maybe the Democrats will already gain control before we get to December 6th in that runoff election. Meanwhile, on the House side, it looks like the Republicans are going to retake the House, but even that's still a little bit too early to call, though it looks like it's probably going to be Republican based on the projections that I'm looking at now, probably in the 80%, 85% range. John, with all that said, if we have a split Congress, assuming that we do get Republican House and a Democrat Senate, what do you anticipate in terms of that OZ reform legislation that I've already covered throughout the course of the event today? Do you think it's going to pass? When do you think it's going to pass? I'm going to ask you to gaze into your crystal ball here.
So my predictions are a little less accurate than real player politics.
Fair enough. Great caveat.
No, I think I'm encouraged because I think that, having a split Congress, there'll be some interest in the Democrats getting some things done before year end. I know, we have to have an extenders package or some tax title. Likely this would be part of an extenders package, which would be part of a bigger bill. So, assuming it gets tacked on the omnibus bill or something like that, there'd be some negotiation. I know that in that extenders package, the Democrats are real interested in the child tax credit not being reduced, which is supposed to sort of partially sunset this year. So it's, I think it's important for them to get extenders in if they can do it. And the fact that it's split, this is a bipartisan bill. So I think we're sitting in a good spot that we have a bipartisan bill in a split Congress. And, again, I don't have a crystal ball, but it could have been a worse outcome, I think, for us.
Yeah. Well, that was, go ahead, Paul.
Yeah. One of the more interesting things in there that I'm focused on is the fund of funds provision. If we get a fund of funds provision, I would expect a certain element of Wall Street to come on board in this program to form and run fund of funds. So that's further upside if that tax bill happens, I think, in terms of money flows.
Good.
I did say Congress was split. I guess I was sort of relaying my thoughts. It isn't yet, right? So it's
not yet.
It may end up being red, but
it looks like that's probably where we're headed. About an 80% chance that we end up with a split Congress, but it's too early to call still. I was hoping we'd have a
and I think
definitive answer.
If it's not split, if it ends up red, I think there's probably a good chance nothing happens this year, but it doesn't mean it's dead. So.
Yeah, well, the good news is that in the brilliance of this, the Opportunity Zone Act, as it was initially written, it's a bipartisan and bicameral bill, and the reform legislation that got introduced in April is also bipartisan and bicameral. So we'll keep our fingers crossed. Hopefully that passes. We got a couple more minutes. I wanted to get to a couple questions here. We've got two questions from Michelle. Actually, Michelle asks, how can we get a comprehensive QOZ fund report since there isn't an integrated federal system, can you anonymize the funds and report out by region? I guess this is a question for John. And I just linked to your most recent report in the chat also.
Right. I mean, so we publish that twice a year. And it's on our website. So if you linked it, that would be the only place I know to get it.
There you go. So Michelle, check out that link to the Novogradac survey data in the chat there. That's probably as best as we're gonna get with, in lieu of a federal report. Michelle also asked, of the multifamily investments that have been made in OZ funds, how many are using federal funds to also create affordable housing? Do you have any insight into that, John?
I mean, there are, I don't know the numbers. I'd say the majority are market rate. But there are funds that are focused on affordable housing that have done a number of deals. And I lead our Opportunity Zone working group, which we have sort of worked through some of the issues in the regulations that we felt we could modify to help the investment on the affordable housing front. And so we've actually spoken to Treasury about these modifications and felt pretty good about the response, but we're still sort of waiting for them in the regs. But.
Good. We got time for one more question here from Bruce. He asks, do the investments in OZ funds track roughly the same as the public REIT market? I don't know if either one of you is tracking how OZs are flowing into, or how equity is flowing into OZs versus the public REIT market. That question's up for grabs for either one of you, if you know.
I think there's a question there about fees. I mean, the REIT market is, hundreds of billions of dollars now. It's, 700 billion, whatever the market cap is. It's huge. They're all internally managed. They're not externally managed in the REIT world. So management works for the REIT. They're employed by the REIT for the most part. Very different creature, very different tax creature. In terms of the compensation and things like that. I haven't seen anybody put together a fee chart of all the OZ funds, but I
would guess that the REIT market would have more stabilized assets. Opportunities.
Yeah, they don't take development.
Have to have value-added assets. There's a little more risk, hopefully a little more return around it, but the REIT markets tend to be stabilized.
So, yeah, not as many opportunistic investments in the REIT market, and by definition, all of the OZ funds have to be opportunistic. And just to answer Bruce's question, he asked, "Do we have a chart of investments that outline the funds, fees, and charges?" Kind of yes and no. So it'd be very difficult to put together such a chart because the fee structures of these different QOFs oftentimes are so different. It'd be like comparing apples and oranges in many cases based on the different prefs and waterfalls and how they calculate the pref, whether it's compounded or not compounded and over what time period and what type of asset management fee there may or may not be, development fees, acquisition fees. It'd be very difficult to do. That said, for the funds that are presenting on this event today, we are going to have as much information on each of them as possible in an investor deck that we're going to circulate to everyone who registered for this event today. We'll get that out probably in the next day or two. So sit tight there. It's easier said than done, but we're doing our best to do it. That's it for our time today, gentlemen. Paul, John, thank you so much for joining today. Really appreciate both of you gentlemen being here, and thank you for your leadership in the OZ industry.
Thank you, Jimmy. My pleasure.
Thank you for inviting us to participate on your panel. It's a pleasure.
Absolutely. Thank you, guys.